In today's market update, we're going to be taking a look at the S&P 500. I've had many requests to update the analysis that we have been tracking in the US markets, and I'm going to be doing that in today's market update. First of all, tomorrow is Thanksgiving in the United States, so happy Thanksgiving to all of the members of the Hurst Cycles community in the United States. And we've had many queries about whether we are bringing back our Black Friday and Cyber Monday special deals. The answer is yes, we are, and I will put some information about that in the details under this video. So take a look there if you'd like to take advantage of those offers. They are always very popular. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So let's take a look at our analysis of the S&P 500, and in my previous market update, which was on the 23rd of October, I believe, which was somewhere round about over here, I mentioned that we were at a critical juncture in the markets where the market needed to show us which way it was going to go. And I would encourage you to take a look at that video and all of the previous market updates to understand what it was that we were discussing at that time. The simple summary is that we were either looking at the 40-week cycle trough having formed back here in October, or we were still considering the possibility that the 40-week cycle trough lay ahead sometime here in November. I titled that video A Critical Moment because the market needed to show us which way it was going, and it needed to do that really soon. Well, it did. It was pretty much just a day or two after that video that the market showed us which way it was going by pulling up and away from the 20-day cycle FLD, which is this purple line shown on the chart over here. So the market revealed itself, and by making that move up and away from the 20-day cycle FLD, it confirmed the possibility that the 40-week cycle trough had formed in the beginning of October. So there are a few points to make. One of the things I'd like to say is something that I perhaps didn't make very clear in the previous video. Once that 40-week cycle trough had been confirmed, that of course changed our expectation in terms of the other possibility. Now, the other possibility showed a big and important nest of lows here in the middle of November. And there was discussion in that video and in previous videos about that date. Middle of November is likely going to be an important time. There was a big nest of lows down there, and so that is what we were looking at and focusing on. But that was only one of the alternatives. And what I perhaps didn't make clear enough in my video in October was the fact that if the 40-week cycle trough did indeed form in October, then of course that nest of lows in November had been converted into this nice little neat stack of diamonds and was therefore no longer a nest of lows. It was no longer an important date. One of the dangers with being a cycle analyst is that we hold on to dates and we see them and they give us a nice confident feeling we're expecting something in November. But then if the market acts in a way that indicates that the cycle analysis needs to be adjusted, we need to let go of those ideas. And we need to let go of the fact that November was an important date because it happened in October. Okay, it wasn't a big change. It was simply something that happened slightly earlier than expected. So what has been happening since then? Well, I've called this video Upward and Onward because that is indeed what has happened. The market has been continuing upward very determinedly since that time. So this is one of the options that we were expecting. And that bullishness is not really a very big surprise because of the fact that a 40-week cycle trough formed over here at the beginning of October. So when a 40-week cycle trough forms, that's a fairly big trough, and so of course we expect price to move out of that trough with some degree of oomph, and we expect it to move upwards fairly strongly. The strong move that has ensued, however, is stronger than was expected on the basis of our bigger picture. So in a moment, we're going to take a look at that bigger picture because we need to adjust our ideas about that bigger picture because of the strength of the recent move. However, let's, before we take a look at the bigger picture, focus on the shorter term detail and discuss, as I have been in this series of videos, the series of interactions between price and this 20-day cycle FLD. So you know that following the trough of a cycle of at least 80-day magnitude, the first cross above the 20-day FLD is labeled an A category interaction, and in the previous video I mentioned targets for that A level cross, which was somewhere up here around about 3080 if I remember correctly. So of course those targets were achieved. The next interactions are where price pulls back down towards the FLD and often finds support at the level of the FLD. The B category interaction is as price moves down towards the FLD at around about the time of the 20-day cycle trough. The C category interaction is as price pulls up away from the 20-day FLD following the trough of the 20-day cycle. So I discussed these potential interactions in the previous video because of course that was what provided us with our critical moment. The next interaction is a D category interaction as price moves down and usually crosses below the 20-day FLD as price forms the 40-day cycle trough in the market. So when did price come down to form this 40-day cycle trough? Well, according to this analysis that we see in our charts at the moment, the 40-day cycle trough was over here. And so the price move down into that 40-day cycle trough was a miserable little one-day downward move. Nevertheless, that was the move down into the 40-day cycle trough. That is our D category interaction. Our E category interaction is what follows that as price bounces out of the 40-day cycle trough. What is the next interaction that we are expecting between price and the 20-day FLD? It is, of course, the F category interaction. That interaction occurs when price crosses down below the FLD on its way down to the 80-day cycle trough. So the 80-day cycle trough, you can see, is expected in about the first week, perhaps the second week of December. That is the next trough that we are expecting. And of course, we are focusing on troughs because Hurst declared or discovered perhaps in the 1970s that the cycles that influence stock markets have synchronized troughs, which means that they do not necessarily have synchronized peaks. The peaks are synchronized, the cycle peaks are synchronized, I should say, but they are not necessarily synchronized. And if you don't understand that concept, I would encourage you to download the core concepts document that I will also put a link to in the description below this video. It's a very important concept. It is mathematically impossible for cycles of different wavelengths to have synchronized troughs and synchronized peaks. Nevertheless, that is why we are looking at the troughs here and we are focusing on the troughs. So we are expecting an 80-day cycle trough in about the first or perhaps second week of December. Price is expected to move down into that 80-day cycle trough, of course, because that's how a trough is formed. And the F category interaction is when price crosses below the 20-day FLD. Now, usually, as I've mentioned in previous market updates, an F category interaction provides us with a very good, profitable short trading opportunity. Is it going to provide us with a good short trading opportunity in this situation? Well, it might do. But it's very important when considering what the markets are doing to take a look at what is happening. You can't just simply, follow the black and white rules. You have to understand or use your Hurst Cycles analysis to really understand what is happening in this market. So there are several really important points to notice. The first is that the B and C category interaction that we see over here usually comes down to the 20-day FLD and finds support at the level of the 20-day FLD. You can probably see for yourselves that price didn't even reach that FLD. There was perhaps support provided, but it didn't even touch the FLD. Now, that does not indicate that there's something wrong with this whole idea. It reveals to us that there is bullishness that is present in the market. Where does that bullishness come from? It comes from the longer cycles. And in a moment, we're going to take a step back and take a look at those longer cycles, because as I've mentioned, the current bullishness is an indication that those longer cycles are more bullish than we have been expecting. And so it's a very important thing that we need to now reconsider. Nevertheless, that was the first sign that there was some bullishness in the market. The next sign that there is bullishness in the market, and in fact it would seem to be an increasing amount of bullishness, is that the D category interaction did not bring price down below the 20-day FLD as it is usually expected to in the formation of the 40-day cycle trough. It didn't even get near to the 20-day FLD. Again, that doesn't indicate that there's something wrong with this. It's a very important indication that there is so much bullishness in this market the price couldn't even get down below the 40-day FLD. So we are expecting price to come down below the 20-day FLD in the formation of the F category interaction as it comes down to the 80-day cycle trough. Usually that gives us a good short trading opportunity. I've got to say, with the amount of bullishness that we have seen over the past several weeks, the possibility that that's going to be a really good, profitable short trading opportunity is greatly diminished. The bullishness that we are seeing in the market is still there. There is no evidence that it has changed. Yes, the market might drop really suddenly and we might miss a good trading opportunity, but the chances of it being a good trading opportunity are reduced, in my opinion. So I'm not going to be jumping into that short trade because of the amount of bullishness that has been present in the market. So let's talk about all of that bullishness. As I mentioned, we need to take a look at the bigger picture to understand where that bullishness is coming from. So if we zoom out a little bit, just to remind ourselves of what's happening in terms of the big picture, here is a quick summary of that. At the end of 2018, the 18-month cycle trough formed in the market. Now, we've been discussing that as an 18-month cycle trough for some time, so that's no surprise to anybody. And we have since then seen the first 40-week cycle trough, which has created this shape over here into the 40-week cycle trough at the beginning of October. Now, the next 18-month cycle trough is part of this nest of lows over here, which, as you can see from the circle and whiskers of the longer cycles, is in fact a very important nest of lows. It's indicating, according to this analysis, a potential trough of 9-year magnitude. This is why we've been expecting the markets to move downwards strongly to form that 9-year cycle trough, which is expected in about the middle, perhaps late next year. And so the first 40-week cycle is expected to be a fairly bullish one, and indeed it was. That is a bullish cycle, there is no argument. The next 40-week cycle is then expected to be a bearish one in order to bring us down into that big important nest of lows. The fact that the market has been moving up so strongly at this particular scale, this zoom scale that we're looking at, doesn't deny this analysis at all. It is a little unexpected having such a strong move upwards, considering that we are expecting a bearish 40-week cycle to bring price down into that trough. But nevertheless, it is still perfectly viable. It does raise a few question marks, and we're going to zoom out again in a moment and take a look at the even bigger picture to discuss why this might be happening. So what is happening here? Well, for some time now, for many months, I've been discussing this trough here at the end of 2018 as being a trough of at least 18-month magnitude. And I'm always fairly careful to say at least 18-month magnitude, because that is what I call my level of confidence in that trough. It is definitely 18 months. It's a trough of at least 18 months magnitude. It is also possibly a trough of even greater magnitude. So it is probably time for us to start discussing that possibility. Because if this trough in December of 2018 is of greater magnitude than 18 months, then that could potentially explain the current bullishness of the market. So let's zoom even further out and ask ourselves what this magnitude of the Christmas 2018 trough might be. Well, this analysis, as you probably know if you saw the big picture video that I recorded several months ago now, this trough here in February of 2016 is probably a trough of 54-month magnitude. For a long time I've believed that's the magnitude of that trough, and I still think it probably is. So following the trough of 54-month magnitude in February of 2016, we expect 3 18-month cycles to elapse before the next 54-month cycle trough, which according to this analysis is also potentially a trough of the 9-year cycle. Let's ignore the 9-year cycle just for now and say that we are nevertheless expecting an important 54-month cycle trough to occur in the middle or towards the end of next year. So let's take a look at these 18-month cycles that have elapsed since February of 2016. So here is the first 18-month cycle, and it is, as you can see, a very bullish cycle. The next 18-month cycle is expected to be less bullish, and indeed here it is. It is a less bullish cycle. It's not a very bearish cycle. It did, of course, end a little lower than it started, which is a bearish sign, but it also had a late peak, which is a bullish sign. So it's what I call a mixed cycle or a neutral cycle, but it is certainly less bullish than the previous 18-month cycle. Now you'll know from previous discussions about this big picture that of course the third 18-month cycle is expected to be less bullish than the second 18-month cycle, because it is of course expected to bring price down into this really big nest of lows over here. So this third 18-month cycle that we are currently in the midst of is expected to be less bullish than the previous one, which was a neutral cycle. In other words, we're expecting this 18-month cycle to be a bearish 18-month cycle. And that's what I mean about this being a surprise, suddenly seeing this bullishness in the market, because we have been expecting a bearish 18-month cycle to unfold. The fact that price came up over here and created some new highs, higher than the highs of 2017 and 2018, was not really a big surprise. They weren't really much greater highs, and they didn't rule out the fact that this could turn into a bearish 18-month cycle. But the fact that price has risen so strongly over the past few weeks is making this a very difficult cycle to turn bearish. Yes, there is the possibility that price is going to come down really very hard and give us a big drop down into here, and I know there are some analysts that are expecting that. Although that is a possibility, I prefer to look at what the market is actually doing and try to understand it in a way that makes sense without expecting sudden crashes or huge drops in the market. And there is an explanation that I would like to suggest, which does make sense out of the current market action and makes it a little clearer what we can expect. And that is the possibility that there is a 6-year cycle that is active in this stock market. Now, the 6-year cycle is a very questionable idea. It's not something that Hurst defined. It's an idea that was introduced to me by a Sentient Trader user several years ago, and it's a very interesting idea. I'm not going to discuss it at length here. I have done that in previous videos, but the idea is that although we expect 3 18-month cycles to elapse between each 54-month cycle, that there is evidence that in fact there is also a 6-year cycle active in the market, which means that every fourth 18-month cycle actually turns out to be a fairly prominent 18-month cycle trough, more prominent than would be expected. And that's very much the situation that we are looking at here. So here is an analysis that shows a 6-year cycle included in the nominal model that I'm analyzing with. I've zoomed out this far just to give you a few of the basics of this analysis. You can see there is a 54-month cycle trough in early 2009, of course. Then there is a 6-year cycle trough over here in late 2012, which tends to resolve some of the discussions that often ensue about that price action around about that time. It also has a 54-month cycle trough in February of 2016, which matches exactly with the 54-month cycle trough that we were looking at a moment ago. But the important difference is what happens around about the trough that formed at the end of 2018. So let's zoom in and take a look at that. According to this analysis, which assumes that there is a 6-year cycle active in the markets, you can see that 6-year cycle has formed a trough over here at the end of 2018. Now, I know that's a slightly odd graphic because you're used to seeing these neat stacks of diamonds, and that's a floating diamond with a missing diamond, if you like, underneath it. So it's an unusual concept, and I have to tell you, this breaks one of the fundamental principles of Hurst cyclic theory. So it's one that I introduce as a fairly speculative idea, but it's one that often seems to work in the analyses that I look at, and it certainly explains why we might be seeing a not very bearish 18-month cycle elapsing at the moment. So just a quick reminder, on this analysis, we have not very many differences. We have the first very bullish 18-month cycle over there. Then we have the second less bullish, neutral, perhaps slightly bearish 18-month cycle that elapsed over there. But now our quandary comes in because we have a more bullish than expected 18-month cycle elapsing. This analysis provides a possible explanation for that, which tells us that the 6-month cycle, and I often refer to it as an harmonic echo, because I don't believe there is a 6-month cycle, but there is an echo that develops between the cycle waves. And if you study cycles in music and in many other ways in which cycles manifest in our lives, you'll know that, of course, cycles form harmonics between themselves. And so I think there's something that could be called a harmonic echo, which is of 6-year in wavelength or in apparent wavelength. And so if that formed at the end of 2018, that would explain the tremendous bullishness that has occurred since then. And it gives us a practical explanation for why this 18-month cycle is not turning out to be as bearish as we would have expected. So how much does this potential of a 6-year cycle, which might not even exist, affect the way in which we can understand the analysis and what to expect next? In fact, it really doesn't change very much. All that it tells us is that there is a reason to expect this amount of bullishness. We are still expecting an 18-month cycle to play out over here and to give us a move down into the middle of next year. You can see that according to this nest of lows, this cycle trough that is expected in the middle of next year or towards the end of next year is still a 54-month cycle trough. So it is still a prominent trough. However, the potential that a 6-year harmonic echo of a cycle formed a trough at the end of 2018 gives us a reason not to necessarily expect this 18-month cycle to be as bearish as we would expect it to be if that harmonic echo wasn't there. I do hope that this concept doesn't confuse you, because I did not want to confuse you with this idea. The important thing is that whichever analysis you are looking at, and here is that 6-year analysis, there is really very little difference in terms of the interactions between price and the FLD. We can label the same sequence of interactions on this analysis. There is here are B and C, D and E somewhere over here, and of course our next interaction is still expected to be the F category interaction. But as in the chart that we were looking at earlier, there is clearly a lot of bullishness in this market. Is the F category interaction going to be a good short trading opportunity? I don't believe so. Are we expecting the market to come down into a big cycle trough in the middle or towards the end of next year? Yes, we are. No matter which analysis we look at, we're expecting that. But the fact is, there is a lot of bullishness in this market. I'm not jumping into short trades just yet. One of the dangers of being a cycle analyst is that you're always looking for that next move down into the next trough. We need to enjoy the bullishness of this market for as long as it lasts. Price is expected to come down and form an 80-day cycle trough in the first or second week of December. Then it's going to bounce out of that 80-day cycle trough. We need to constantly track the degree of bullishness or the degree of bearishness as it develops in this market. But certainly at the moment, it is, in my opinion, upward and onward until we form the 18-month cycle peak. I do hope that you found this market update interesting and useful. If you have any questions, please don't hesitate to put a comment below this video. Happy Thanksgiving if you're in the United States. And as always, I look forward to hearing your thoughts about what is happening in the markets.